Can that $1 million not only pay itself back through additional growth in revenue, but can it also pay and manage and handle the fees and debt service associated to it? You may think that it's actually a lot less expensive, and it is, but that private debt might actually be a better option for you and may actually cost you less. Is remember, the more you work with a lender, the easier it is for you to get the money, the less you talk to someone individually, the less someone knows about your business, the less they also care about you. The reality is, in business-to-business loans, the annual percentage rate is a lot less important to you than what we've talked about already. That is the safest and most risk-free way for you to take advantage of those dollars that someone's providing to you to turn around and generate opportunities. Welcome to the next episode of the Construction MFers podcast. I am 𝗏𝗏𝗃𝗃, CEO and founder of Mobilization Funding, and today we are going to tackle why you're overpaying for loans. I have no guest, it's just me, and we're going to tackle all things you need to know about loans, loan structure, and really calculating the true cost to you and the uses and benefits for you as the consumer of the loan and what you want to do with it. So let's get into it. What if I told you the loan you thought was actually saving you money cost you a lot more? Not only in real dollars, but in opportunity, within mistakes that could be made, or loan structures. What if I told you that you could take out a loan that actually has a lower annual percentage rate, gives you more money, but then keeps you from actually being able to take any money out of your business, or use monies for certain things in your business, or you get halfway down the road and because of certain things called loan covenants, you break them and now you're in trouble and your whole business can be in jeopardy. All things that you need to analyze when taking out a loan above and beyond just the cost. We're going to tackle annual percentage rate as well, but don't forget about fees. There's unused line fees, there's hidden fees, there's closing fees, but sometimes there's just advance fees and fees in general. And if you're not paying attention to those things, the true cost of the loan can far exceed the actual annual percentage rate. And other times, the annual percentage rate may be really high when calculated, but because of the structure of the loan and the way you're going to use it and how well it aligns to your business and your revenue cycle, sometimes it can work perfectly and actually cost you less money. That's another thing we're going to tackle. What's the total and true cost of capital? Meaning, how much did I actually use and how much did I actually pay back? That delta is the true cost of the capital. Sometimes getting more money up front and then having to figure out how you're going to use it over a 1, 2, 3 month period, or sometimes it might be a 1, 2, or 3 year period, is much more difficult. Even if you could get $1 million today to infuse into your business, you have to have uses for that $1 million today and put it to use right away. What is the return on investment going to be? What are you going to use the money for? Is that money going to directly generate new revenue growth and new profit for you so that you can not only pay that $1 million back, but also any interest and fees associated to it? And this is the key part. Can that $1 million not only pay itself back through additional growth in revenue, but can it also pay and manage and handle the fees and debt service associated to it? That's what we need to figure out. We're going to give you some real examples and show you how to exactly do that. One example I want to go through is an SBA loan. Now, the SBA is great for a lot of reasons. If you're talking to a bank, sometimes they'll tell you that the SBA is actually expensive because compared to a commercial bank loan, it is. Closing fees are higher, interest rates are a little higher, and sometimes they actually ask for more security or collateral from an individual level than the regular bank. But compare that to factoring companies or other private debt. You may think that it's actually a lot less expensive, and it is. But that private debt might actually be a better option for you and may actually cost you less. The things that are important to consider, take for example, an SBA loan may give you more money at a lower cost, but that more money comes to you all at once. And even though it has a lower annual percentage rate, the actual cost of the loan might be much higher on an annual basis, meaning it might cost you $100,000 to service $1 million loan, whereas you might borrow $200,000 or $300,000 or $1 million over the course of a 3-year period, but it might only cost you $100,000 over that 3-year period because the way you can use it, access it, pay it back. So even if it's a higher interest rate, but a better structure, your total cost of capital and your risk may be a lot less. That's just one example. When analyzing a loan, what I think is really critical and the most important thing you can do, regardless of cost, regardless of rate, is you want to make sure you're getting the right amount of money for what you know you can use it for. Let me explain. If you're borrowing money that you know you can directly put to work to increase your revenue and increase your profitability in the company, those are good uses of dollars. And even if that money might cost you a little more in an annual percentage rate than other money might, but the structure works for you and you know now what you can use it for and you get the right amount, it's okay as long as the math problem that you've calculated works for you. So higher cost of debt, meaning annual percentage rates higher, but it's the right fit and the right structure, and it's the right dollar amount that you know you can put to work to generate a certain other number of dollars over a period of time. That equation, when positive and measured against the risk, is the best and ultimate outcome for you to consider when making the loan. On the alternative, you can take the same amount of money, even if they give you a longer time to pay it back, and even if the rate's a little lower, and they give you all of it at once, you now have to service all of that debt at one time, utilizing your own methods to pay it back. If you can only use 50% of the amount they give you right now that you know can generate revenue, you could very well take that 50% of the loan, put it to good work to generate new revenue for you. But because you didn't know when or how you could use that other 50% and it's just sitting in your account, but yet occurring cost on it, even at a lower rate, that additional cost and that money you don't have a direct use for right now, although it feels good to look at it in your account and it feels good to have it on hand, it actually eats up your opportunity for which you put the money to work in the first place. So getting the right amount in the perfect structure, not only how you can use it, when you can use it, but also how you can pay it back and when you can pay it back, such that you can manage the total cost of capital for the opportunity you have. That is the ideal structure. Now, if you can compare two equal structures and now you're down to looking at cost, then of course you can choose the lower annual percentage rate. What's important though is remember, the more you work with a lender, the easier it is for you to get the money, the less you talk to someone individually, the less someone knows about your business, the less they also care about you. Naturally, if you can go on to a simple platform, type in your information, figure out a number that they'll give you and an interest rate and deposit that money in your account, and they've never spoken to you, they don't know what you're going to use the money for, and they don't know anything other than the information you've put in, it's safe to assume they definitely don't care about your business. They care about getting paid back, which all lenders do. But if you're working with someone who understands your business, understands the uses of the dollars, can help actually pour some value into you during the process or after the process, and can help you put the right structure together, even if the cost is higher, you might want to consider some of those advantages of someone knowing your business, caring about your business, and someone you can rely and trust on, especially if they're giving you value. When you're considering different banks, private lenders, if you're considering factoring companies, these are all good, solid ways to make decisions over which types of lending you can use. And when you're looking at material financing or companies like ours, mobilization funding, the way you can communicate and talk to them and what they understand about you, your use case, and how you want to spend the dollars are great things to compare to prior to just comparing cost. And again, if you're comparing cost, you want to make sure it fits into the cycle of which you're going to use the money. It can generate more revenue for you. It can generate more profit for you. You can pay it back in the term that you need to. And if you have the opportunity to use it over again and over again, when and if you have the opportunities, then that's the best case scenario. Let's talk about other uses of dollars. All right. Now, if you're building out a 3-year plan and you're in the construction business and you want to get all the capital you need today for that 3-year plan, that's going to be a tough go. One, construction has a lot of ups and downs. All businesses do, candidly, but construction, manufacturing, and any other business over a 2 or 3 year period, when you're in the growth cycle, it's really hard to determine how much money you need today versus how much money you're going to need over what period of time. What's important to know is if you build out a 2 or 3 year model and you know how much money you need, but you have to take all of the money up front when you start right away, you have to carry the cost of that money throughout the entire 3-year period. Why is that hard? Well, one, you don't have all the benefits of your opportunities at the very beginning, but you have all of the debt at the very beginning. If you had a structure that allowed you to access the money as you need it in tranches or in drawdowns over that period, that would be a better structure for you. So consider those types of structures and the uses of the dollars and how you're going to spend those monies prior to just taking a big lump sum of money up front. It's actually better if you have access to the money to do it, but you don't have to pay for it. You can draw it down and only pay for what you're using so that you know you have the money to start executing the plan, but you don't have to pay for all the money prior to actually drawing it down or putting it to work. This is what will help you align the opportunity for what you want to use the money for to when you actually take the money. And then as you recoup and you start to enjoy the benefits of what you're trying to put that money to work for, now you can take the profits from that, pay down the debt service as well as some of the principal. That is the safest and most risk-free way for you to take advantage of those dollars that someone's providing to you to turn around and generate opportunities. All right, I want to discuss APR, annual percentage rate, with you. It is an important tool. It's important to understand. It's a tool that all lenders are going to use, somehow calculate. The reality is, in business-to-business loans, the annual percentage rate is a lot less important to you than what we've talked about already. Covenants, sources, the ways you can use it, the type of lender you're borrowing from, the type of capital you're using, what their expectations of you are in both reporting, covenants, financial covenants. So I want to touch on financial covenants. Financial covenants are essentially rules. The lender wants to tell you, yes, you can use these dollars. You can have them to use for the sources and purposes that you want. However, here's the loan covenants. Here are the rules. You have to use them for these dollars, or you have to use them for these purposes. You have to pay it back in these particular periods of time. Those covenants are really critical. And they're not just the terms in which you're payment back. They could be covenants like you need to maintain a certain debt coverage ratio. You need to maintain a certain tangible net worth. You need to maintain a certain debt to equity ratio. You need to make sure you cannot take a distribution out of your company until you have so much dollars in equity, or you can maintain on a quarterly basis other ratios. It is really critical that you look at the fine print of what the loan covenants are, because beyond annual percentage rate, you could take the lowest cost loan, but they have the wrong financial covenants. And more importantly, if you break those covenants, what are the repercussions? Those are things that could put your business at risk. You want to make sure you understand those loan covenants, or AKA the rules for which the loan are going to be guided under and the lender wants you to operate under. All right, for our construction loan, folks, when you're trying to calculate the true cost of a construction loan, and you're looking at it either project by project or across multiple projects, here's a great way to figure that out. Each one of your projects has its own unique revenue cycle. Revenue cycle means how you have to spend the dollars that are going to be attributed to the project, and when you can invoice the project, and of course, when you're paid. They all are a little different. Sometimes materials have to be ordered in advance, sometimes they don't. Sometimes you have a lot of labor on a project up front, sometimes it's spread across the project perfectly. Those are the kind of things I'm talking about. What's really critical when you're considering debt, if you can't marry up the exact amount of money you need to exactly when you use it, You want to be really careful with understanding how you can get those dollars into your business and when. And if you pull all those dollars in up front to forecast across a project that might last 6 months, you now are carrying all of those dollars across a 6-month period, which can end up costing you a lot more. Even if the interest rate is lower on a specific dollar amount and you have a longer period of time to pay it back, that is actually more detrimental to your business in a construction loan scenario or construction project scenario than if you could actually have a line of credit that worked perfectly and you could draw it, pay it down, draw it, pay it down, draw it, pay it down. Now, the problems with line of credit for construction companies are that very often they're never large enough for what you need. Your typical construction project may require 20, 25, or up to 50% of the cost of the project that you have built into it have to be spent before you're even cash flow positive. There isn't a lending company or a bank that I'm aware of that will give you a 50% loan to contract at a traditional bank in a form of line of credit. So that's really tough to use. So it's really hard to actually pull those dollars out. The next thing I want to talk about is using your different forms of debt for the right uses. A line of credit is a terrible way to buy a piece of equipment and keep it financed that way long term. Meaning, if you have a $250,000 line of credit and you have a $100,000 piece of equipment and you need to make a quick deal with it, yeah, buy the piece of equipment with your line of credit, but then quickly find permanent financing for that piece of equipment financing. You're going to get better rates. You're going to get better terms. You want to spread the loan out and the payments for that piece of equipment with the life of that piece of equipment. If you would have just financed that with your line of credit, you're now hurting yourself from an opportunity cost. You're probably hurting yourself a little bit from the cost of capital. And you're also depreciating the amount of cash you actually have available to you in the form of liquid cash, which a line of credit is. A great way to figure this out for a construction company as it relates to a project and determining how much you need is building out a cash flow. And what I mean by cash flow is figure out how you have to spend those dollars on your project, when you have to spend them, when you get to invoice the project, and when you're paid, and map it out in a weekly cash flow. It'll quickly tell you whether you need 20, 25, or 50% of the actual costs attributed to the contract to invest into that job before it's actually cash flow positive. Once you determine and use a cash flow tool, that project cash flow tool can then tell you exactly the total amount you need, when you need it, what the uses of those dollars will be for, how much you're going to pay back and when across each individual pay application, and of course, if you're cash flow positive or not on the job. You could be profitable on a job, very profitable. You may never be cash flow positive on that job. And if you have to get to the end of the job before you're cash flow positive and even receiving retainage money back to be profitable, well, that's a scenario where you're probably going to be investing 75 to 100% of the cost of the contract into that job. That means you're going to need that much cash available throughout the life of the job in order to get to the point where you're profitable. Those are tough scenarios to live in. Most can't be successful in those scenarios. So it's critical to use a project cash flow tool, not only to figure out when you are cash flow positive, but also to determine if you have enough cash to do it. And if you do have enough cash, how much you need to keep on hand, when you need to use it, how you need to use it, and most importantly, how you can go about paying it back. All right, let's wrap this up. I'm going to give you a little quick summary on the framework so you can stop overpaying for loans. First, let's begin by mapping out the use of the dollars, what you want to use them for, how you want to use them, and start assessing all of the variables aside of just cost. And not just cost, but let's talk about annual percentage rate, which is the rate in which you're going to pay interest. Let's talk about the total effective cost, which is the amount you're borrowing and how much in total you're paying back. Let's compare the loan covenants. Let's look at all of those things. That's the best way to stop overpaying for loans. Next, cash flow projections. Map out those cash flows. If it's project-based, if it's PO-based, if you're just starting a new customer account, map out what those cash flows are going to look like so you can make a good, effective decision on the total amount, when you need it, how you need it, and so you can use the dollars at hand in the best appropriate way. Next, ask those lenders the right questions. Make sure they understand your business. So that's going to eliminate a lot of folks. If you can't talk to them or they're not even from the lending company, then you know for sure they definitely don't care about your business or the uses of it. They do care about giving you a loan and they do care about getting paid back. And it does not mean they're bad people. It just means they don't really care about your business, what you want to do with it, how you want to do it, and they're not interested in helping you succeed. They are interested in helping assess who you are, what you're going to be able to do, and your ability to pay it back, but they're definitely not interested in your business. Tools. What types of tools are you using to analyze these opportunities? Do you have good dollars? Do you have good metrics? Do you have good data? Are you speaking to your accountant? Have they built out a pro forma for you? Have you done any math on what you're using the dollars for and how you can pay it back? Make sure you're putting proper tools together to make the best possible decisions you can. If you're just making these decisions based on your gut instincts, it's going to be a lot more risky than if you're making those decisions based on good data, good information that you can count on, and then using your gut instincts to make that choice. Last, please, no matter what you do, before you take out any loan dollars, analyze your projects, build out these cash flow tools, take the time and effort to put these things together so that you can make a good decision. You've busted your ass to grow your business, hire people, take care of you, your family, and all those things. Don't make a mistake by getting in the wrong debt structure or you borrow too much money. It is so important for you and your business to make sure you have a healthy relationship with not only the debt you take, but the people you work with. Take the time you need to analyze that. If you don't have all the pieces, it's better to pause and figure it out than it is to rush into a decision. Take back control of where you borrow from. Don't just focus on the annual percentage rates. Make sure you're taking good opportunity to analyze the data. Think through it, gather information from as many people as you can. Make sure you know the uses of the dollars, how you want to use them, where you want to use them, and you feel comfortable with how you're going to repay it. And most importantly, take your time. I hope you liked this video. I hope it helped you. If it did, please share it. In the meantime, God bless you and have a great week.